welcome to TheoTrade. This is Don Kaufman. August 7th, 2020, doing the weekend update here with a few minutes left to go to the cash close on this Friday afternoon. It's the return of the Bidless beast inside of the Nasdaq. You know, this is the first time throughout the course of this entire trading week that we've actually seen just this inside of the Nasdaq. I'm going to talk about like the Bidless beast. Oh, that's just my name for the Nasdaq, getting downright sketchy inside a trade. You know, net, the day is not turning out to be half bad over here. Yeah, the Nasdaq is down by the tune of 1%. You got still 13 minutes left to the close, but this price action that I've been talking about so frequently in the last couple of weeks, it returned, and that is just seemingly out of nowhere. The Nasdaq turns into the Bidless beast. And if you've never heard the term Bidless, that simply means that there's no buyers out there. You know, I think the best way though to describe some of the trade that we're seeing in the markets the last couple of days, I think really the only word that really describes it, things are totally manic right now. I mean, you can actually point out, of course, the Nasdaq, and looking at the Nasdaq obviously running to all-time highs, having the first pullback that it's had in umpteen trading days. But all right, so you could probably call that a little bit manic. When you start looking at it, though, on a 30-day, 1 hour, here's the point that I wanted to make with that, that conversation, if you will, about the Bidless beast. That's what I'm talking about right there. And again, this is a 1 hour chart. When you can start to see the marketplace getting bidless like in 1 hour charts, I mean, that stuff is absolutely wild. And this particular week, all of that bidless, it completely abated. The marketplace was quiet. All of a sudden, we get into a situation again where we're seeing some fairly substantial movement. And again, it's not about, the fact that the Nasdaq is going to be down 1% and the S&Ps are going to be up. We'll come to that in just a moment. It's just, again, these manic moves. And when I start talking about, manic moves, you don't have to look too far to understand this in context. Look at stuff like UPS. All right, UPS, how can you not call this a manic move? Here's an underlying. And again, all due respect, I know some people are probably going to write me emails here and they're like, well, the fundamentals of this company, really, the fundamentals support this. Look over the last 5 years, okay? For the most part, what does the stock do over 5 years? Absolutely nothing, but decides to come alive literally in the last 2 weeks and trade from the 120 to the almost, let's just call it 160 handle, like there literally is no tomorrow. Again, they're manic moves, and what it appears to be, and I'm going to talk about this in a moment in regards to Facebook, what it appears to be, it really is retail trade, and retail trade is driving much of the moves that you're seeing in here. And when I start to open up stuff like UPS, and I'm just going to go like 14 days out, and you start to pull up stuff like implied volatility, there are telltale signs. Most, and with all due respect, most traders do not see, okay, what I'm trying to display to you on the screen. And it is the most important thing to be able to discern of what I am showing you on the screen. Most people, they look at like UPS and like, oh, wow, that has really gone up, and it's gone up big. Push all of that aside for a second. The single most important thing inside of UPS, it's not that it's actually moved to the upside. It's that when you start looking at the implied volatility, okay, and you start looking a little bit further out of the money over here, and again, what am I really looking at? The out-of-the-money calls, okay, are actually getting more expensive than the at-the-money calls. And then when you start to look at the puts, the skew is similar on the put side, but I can't stress this enough. The implied volatility skew is actually flipping over in here, which is indicative of its retail clientele. They're just coming in. They're like, I need me calls. I need me more calls. You don't have to look much further than this. So the buying of calls is actually driving, okay, the volume of stock and driving the stock itself up. I'll explain it here in just a few minutes when we get into Facebook, which again, Facebook, the skew inverts. Retail is just like a hose. They're coming just pouring in, like a hose over here. But there are absolutely unequivocally manic moves. And is it healthy? I mean, you decide. If you're like a momentum trader, you're like, I love this marketplace. If you're a little bit of a contrarian, which I happen to be, you look at this and you're like, oof, this is going to be difficult if I'm on the wrong side of the position. And I am on some of the wrong side of the positions in stuff like Facebook, which I'm going to show you here, though, momentarily. So again, the return of the bidless beast. But again, the name of the game is the marketplace. They're really, and by the way, that's exactly what I mean with the bidless beast. Seemingly out of nowhere, we're rallying, stop on a dime. Do you recognize how big these moves are? This move is from the 38 handle, okay, the 38 handle, all the way down. These are 1 minute candles, okay, down to the 17 handle. Are you getting 20 and 30 point moves inside of the Nasdaq inside of 1 minute? Okay, you got issues. What those issues happen to be, we don't know yet. But you got issues coming here inside of the Nasdaq, and that's the bigger portion of this. All right, time out. The next thing I want to show you here, the SPX, the mother of all products. Now you see this line on the screen. That line on the screen, that's what we talk about each and every week here. And I'm going to talk about it a little bit later in this video. But the point being here is the SPX, we're not doing anything abnormal. The SPX is actually going to close right on the edge of the expected move, okay? To a T, people. So when you look at the marketplace this week and you say to yourself, oh, that was just a ridiculous move to the upside. Really? Because I bet you anything, the expected move was $71.48. Okay? And what's shocking about this, and what people don't really get, this is a $3,348 product. Okay? The edge of the expected move was roughly at 33.43. So you're supposed to move $71. Oh, I'm sorry. We didn't move $71. What? We're $5 off the edge of that. And with time to go to the close, the point that I'm making over here is how incredible the markets really are at handicapping the risk. Okay, this isn't even about efficiency. I push all that aside. You got to think about this. The line on the game is $71, and we are there. And that's what's important, is to discern that hedging is actually driving trade activity. And I'm actually going to show you that again inside of Facebook. Hedging drives trade. That's all that's driving trade right now. And again, ironically, as I'm saying this, the SPX it's pulling back. It's striving to come right to the 33, 43 in this particular case. Speaking of expected move, I'm going to take a minute here, go around the horn a little bit. Let's go over to the QQQ. The QQQ, which has been, again, Mr. Toad's wild ride. Oh, if you take a look at the auto expected moves, the Qs, interestingly enough, are actually going to close inside their expected move. What's the odd playa this week? Well, that's exactly my next point of contention. The Russell is a rockin' in the rotation game. The Russell, who's the big winner this week? Russell's the big winner. The Russell actually exploded to the upside outside of its expected move. So once again, we're playing the same game. All right. And if you haven't looked at the S&P futures today, so the S&P futures massively unchanged. The Nasdaq down over 1%. The Russell actually popping up 1%. It's the rotation game. Okay. And the rotation game, it really, to get intricate about it, it involves and heavily involves the financials. And I told you the financials are going to trade to the upside over here. We told you about the financials. Okay. We've looked at them extensively. And the moment that you see any sell side activity inside of technology, they rush to the financials. Where else are you going to go? And the financials, and again, if you're unfamiliar with this concept, okay, the financials are just loaded inside of the Russell. So all of a sudden, I went from the Russell, and I apologize for doing this sometimes, but it's seamless for me. The Russell is loaded with like mid-cap and kind of regional banks, loaded with it, right? So for the most part, looking at financials and looking at like the Russell, it kind of makes sense that you're seeing, again, as tech gets killed, they rotate it into financials. They rotate it into financials, and boom, up goes, of course, the Russell along with it. And the Russell cracked outside of the expected move. And this is something that I brought up in context. And in fact, I think I'll bring this up once again. I wasn't exactly planning to do this. We've come over to here to style. We go to load style. I have a comparison, and the comparison is, again, the QQQ, which is our primary symbol. So up here is the Q's, Q, Q, Q. All right. Right over here is another other than what? Okay. If you want to take a look at this, you got the SPY and then the IWM. All right. So you're actually comparing all three major index products together on one chart. And maybe doing it justice isn't necessarily year to date. Let's actually snap the time frame down a little bit. We're actually going to take this time frame, we're going to drive it all the way down to like 3 months, hit OK. And what you can see with the rotation game this week is the exact opposite of what you saw effectively last week, and that is, okay, here's actually the Nasdaq coming in and the other products. And again, here's the IWM coming up. They're actually about to cross one another. Okay, it's crazy. I mean, just it's absolutely manic in this marketplace to see major index products crossing over one another with this kind of degree of frequency. Is, again, some of the stuff is just unheard of. When you start looking, though, at a 3-year time frame, look at like a 3-year time frame, the Nasdaq, I'd say it's a little bit outclassed, if you will, the IWM. That distance over there, mark my words, that's going to close. Okay, how fast? By how, like, stretch of the imagination over here, there's no way to discern how fast it's going to close. Okay, other than if you took this back, and again, this is something that I talked about extensively in recent videos. You took this very, very far back in time. That's a 3-year. Apologize. Let me actually snap to a more definitive time frame for you here. There's 3 years. Look back over the last 15 years. Index products converge upon one another. Sooner or later, they will converge upon one another. And that's why we watch these sector rotations so very carefully. All right, let's completely switch gears over here. So if you're looking at the Russell and you're thinking to yourself, like, all right, so great, the Russell, they're rotating into the Russell, they're rotating out of the Nasdaq a little bit. Listen, there's tons of trades there. Even if you're not a pairs trader, one of the things that I'm doing right now, I've actually been buying some volatility and specifically buying gamma irons inside of the IWM. Again, inside of the IWM, which is the Russell product, if you take a look, specifically what I mean, I'm buying out of the money. I'm actually buying out of the money spreads inside of here with every intention of seeing volatility come raging back. And when I start talking about volatility, what I'm talking about here, this is an IV rank. The IV rank has gotten crushed down, and I expect the IV rank to take back off to the upside. So what am I doing? I'm buying a little bit of volatility in there, where otherwise the volatility, it's dirt cheap in comparison to where it was just a few weeks ago. Same idea inside of the bond market. For this, let's actually bring up the TLT. This is the perfect chart for it. Inside of the TLT, same animal. TLT volatility was absolutely record-breaking a few months ago, back in March and April. Of course, the whole marketplace had record-breaking volatility. But here's the interesting thing. The bond volatility, it has now been crushed back, okay, on a percentage basis, much further than the S&Ps, much further than any volatility on the screen for that matter. So volatility gets just decimated inside of the bond market. Now here, okay, here's where I really think volatility is going to come back. And that's why I say it's gamma time. For the most part, what I'm actually prefacing in this particular case, you can see I've got orders stacked in here right now. I'm also buying iron condors and continue to buy iron condors inside of the TLT with every intention of seeing very substantial moves. In fact, if you just look at like auto expected moves, this was a fairly phenomenal size move in comparison to what we've seen lately. Today, seemingly out of nowhere, we see some sell side activity in the bonds, which the sell side activity in the bonds also sparked, okay, buying inside of the financials. So go figure, right? So as we come into the closing bell, by the way, coming into the closing bell, look at that, the SPX, it's going to do it. It's going to close basically like on the edge of the expected move. I like it. So we cruise back over to the TLT, and I don't want to confuse the situation. I said bond volatility is dead. It is dead, okay? But with all due respect, this is the trade. I'm looking for bond volatility to expand back out. And there's the closing bell. It's over, people. It is over. So if you take a look at the bond volatility, you can see some of my orders are canceling over there. I've had just a ton of working orders in here. I'm actually going out and I'm buying net volatility in the TLT. And in doing so, for the most part, I need an expansion of volatility and some wicked moves inside of the bond market. And in the next 42 days, I absolutely think that is going to occur. Don't discount, people are like, the Fed's got the bond market under control. They may have the short-term Fed fund futures under control, but I do believe we're going to have a bit of a conversation piece inside of the TLT, which actually brings me to my next point. Can bonds actually sell off? Okay. Can the reflation trade actually come back into style? And the entire world right now believes that interest rates are going to be like next to nothing. In fact, when you start looking at this, I think this is a worthwhile idea to discuss. If you start looking at this, we're basically at some of the lowest interest rates ever on record. Now, this is the TNX, which is the 10-year, that's the 10-year Treasury Index. And 10-year Treasury Index is 0.56%. Yeehaw! You could tie up your money for the next 10 years, and you too can get 0.56%. I believe that this could come rocking back to the upside. And I want to reiterate that. I believe that the interest rates itself is going to come rocking back to the upside, which also implies that I believe bonds can sell off. And it doesn't necessarily have to play out that way, but if you look at the entire marketplace lately, I don't care whether you want to look at the Dow, whether you want to look at like some oil. Oil's had a fairly tight range, but oil looks a lot like what? Looks a lot like the bonds do. Okay, so you want to look at the Dow, you look at the SPX, you want to look at, everywhere you look want to look at some metals like gold taking off to the upside. It really is like a bubble of everything everywhere. And if that's true, and some of that starts to unwind, okay, you can see some of the metals coming off today. Maybe that's only going to be short-lived, but I believe that the bonds are really well suited. And I'll tell you why I think the bonds are so well suited. Nobody's looking for it there. Nobody's looking for a big volatility explosion inside of the bond market. Clearly, they're looking for it inside of the S&Ps. How do I know that? Just look at the volatility skew in the S&Ps. It tells you everything you need to know. Everybody's like, I'm in the S&Ps. I'm long, but I'm scared. Hold me. The S&Ps right now, the out of the money puts are still trading for heavy vol. When you start to look at the TLT, you look at the TLT and go look at the out of the money puts. They're not trading for any heavy volatility out there. Like 20% vol. Okay, they're a little bit more than the at the monies, but the skew is really, really mild. So I caution that, the bond market, nobody's looking for the wicked move in here. I am. And that's exactly why I wanted to bring it up. Next on the docket, completely switching gears, we come over to Facebook. Facebook has a wicked 2-day streak. Why? I have no clue. This is one where people are like, how come his stock moved up? All right, I'm going to give you exactly why the stock moved up. Cruise over to Facebook, open up these option statistics. Okay, open up the option statistics. Look no further. Gather round. Right there, look at the number of calls versus the number of puts. It's not a put-call ratio. I hate that. It's not the put-call ratio, okay? It's everything to do with people are just buying calls. That's it. People are buying calls, and they're buying calls with both hands. How do you know that? Because the stock is actually flying to the upside in the last couple of days. By the way, the sizzle index, it's almost 4 times the norm. So this is a phenomenal number. Almost 2 million option trades, okay? Or should I say option contracts traded inside of Facebook today. It's phenomenal. You have to understand. Yesterday, for example, the entire marketplace in options, okay, yesterday's entire marketplace saw 31 million contracts. The entire market saw 31 million contracts. Facebook today does almost 2 million by itself, okay? Facebook does almost 2 million by itself. Then you cruise over to the spiders. Just making a quick point over here of like how order flow can dictate everything. Literally everything over there. The S&P is trading to the upside here. But take a quick look at the spiders. Spiders did 4 million. So if you just added up the spiders and Facebook, 4.2 million plus 1.75 million, what do you got? Between spiders and Facebook, you're already at 6 million contracts, right? The entire marketplace only did 31 million yesterday. Today probably even a little bit less. You look at the QQQ, okay? You look at like the VIX and you start adding things up. Like the QQQ is good for 1.4 million. Look at the SPX, the mother of all products. And the SPX is good for at least 1 million contracts. Before you know it, the point that I'm trying to make with this, okay? Do you guys get what I'm saying? I told you it's good for 1 million contracts. Pretty much spot on. Get what I'm saying with this? It's total concentration of liquidity. Nobody trades anything but the same 5 to 10 products, period. That's why I brought this up. And the skew here inverted, okay? What that basically means, okay, is every little monkey, okay, and their brother is out there buying the calls, and they are buying out of the money calls. So I'm going to explain exactly how this works. So you are sitting at home all by your lonesome. You're a retail client, okay? What you do is you buy a call. You're buying an out of the money call. The market maker turns around, okay, and this is a market maker sells the call. So they sell the call. Then what do? Well, if they sell the call, it actually forces them into a negative delta position. So how do they actually balance the equation? They buy stock. They buy stock because stock has positive delta. They want to always have a neutral delta. So how do you think Facebook goes up? You buy calls. You buy calls, it forces the purchase of stock, forces the stock up. That's it. That's actually what occurs. And the only time you get that is when you get an inverted skew. It's as clear as day. People are buying record numbers of calls inside of stuff like Facebook. They're doing it in UPS. Everybody's just like, again, moth to the flame, moth to the flame. You got to realize how dangerous some of this stuff is. And with that, again, to put it in context, again, this is all about retail traders, and that's okay, and if I hear one more thing about Robinhood, I'm going to start screaming because their order flow pales in comparison to some of the bigger firms out there. But we are all moth to the flame. Facebook's in play. Boom, it explodes to the upside. This is going to be incredibly dangerous. And just reminding you, okay, if you're going to trade a Facebook, you're going to trade like a UPS, if you're going to be in any of these trades where you see the upside looks just absolutely parabolic, I am telling you, get in there with defined risk. Okay, whether you're a client of TheoTrade or not, you got to get in there with defined risk, because everybody, listen, you put a couple grand into something like this, you can get wiped out in 5 minutes. Eventually, these inverted skews are going to flip over, okay, and the music's going to stop. And when you start seeing the skew inverting because retail comes pouring in, you close. Next on the docket, VIX and VVIX, the VIX and the VVIX, the VIX and the VVIX, buy volatility on volatility if only volatility is low. If you have no idea what that basically means, take a look at the VIX. The VIX is inherently low, but the VIX of the VIX, what is the VIX of the VIX? It's the VVIX. The VVIX is also fairly low at this point in time. And again, I believe that the entire structure of volatility in the marketplace is low and it's about to come back up. So I'm not the only one that believes this, because the volatility did come back up very mildly today. This line that's on the screen, this line right there, okay, that's 110, and that's on the VVIX. Okay, this is actually what we call the VAMA zone, the volatility of the volatility zone. And above 110, it's duck and cover, get under your desk and rock back and forth. And we've been in that zone for a long time. We drop below it for a brief and fleeting moment. I think it's a great time to be able to buy some volatility. How do I do it? That's all the key. These are trades that I've actually blasted out. These are trades that I've actually blasted out on text message to all the TheoTrade clientele. But people, when it comes to the VIX, I'm stacked in here. It doesn't look like much, right? A bunch of onesies, twosies, a couple of 4 lots. Yeah, but when you start to break down the inventory over multiple accounts, okay, I'm telling you right now, it's a pretty good time to be buying some volatility. And I like buying volatility in the VIX, obviously. I'd like buying volatility in other products like the bond market as well, because I don't feel like anybody's looking at the bond market right now thinking, I got to buy vol. Last, but definitely not least, in this weekend's update, the SPX expected move. Nothing unusual to see here. The edge of the expected move. The edge of the expected move, we pretty much landed smack on it. Yes, okay, at the actual bell, what are we? We're 4 or 5, maybe 6 points off of it, okay? Forgive me, but it's amazing how efficient, that marketplace has kind of become. We literally, we drive to the edge of an expected move. And right now, okay, the expected move for next week is still being settled out. The SPX options are technically still open for the next 4 minutes. But next week, and here's kind of the crazy part about this is why I like to bring this stuff up. Okay, really crazy part about this. This past week of trade, we had plus or minus a $71 move. That was last week's expected move. And we tagged it, like literally the edge of the expected move is achieved. But then after we tag it, they lowered the volatility. Now the volatility this next week is going to be plus or minus, somewhere around $62. Now that's not perfect yet, but it's somewhere around 62. So they take volatility down even after we made a fairly phenomenal move. Again, I look at this as being advantageous. I continue to not only be on the buy side of option premium, in effect in these gamma irons where I'm actually net buying volatility. I'm using back spreads and so forth still, but I'm buying volatility and it's working. And we've had many of the gamma irons come off profitably, right, in recent weeks of trade, because the marketplace continues to fire off to the upside, but it just doesn't seem like the implied volatility, that is, doesn't seem like the options market is doing a great job of handicapping the risk. Listen, there's a ton to think about in this weekend's update. Again, pay very careful attention to some of these stocks that are exploding to the upside where the skew inverts. Okay, pay very careful attention to bond volatility. It's dead, but the bonds absolutely, I believe, can sell off over here. Again, the last thing, the rotation game. You'll know when the marketplace really starts to sell off. Why? We're going to stop rotating. When you start to look at things like advanced decline line, look at the S&P 100. How chaotic is this? The S&P 100 sees an advanced decline line of basically 70-30, but the marketplace ends up where? Massively unchanged, with the Nasdaq down 1.25%, the Dow up nominally, and the Russell flying. Okay, go figure. The reason I spend so much time on that entire rotation game is for this reason. When we correlate, duck and cover. It's going to get serious. When we correlate, that is when you get like 100 products trading on one side or the other. We haven't seen that now in weeks. Okay, duck and cover. It doesn't matter whether it's to the upside or to the downside. Things, people, they're going to get a little nutty. Look for the return of the Bidless beast a bit next week as well. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.